Wow. And you must be learning a lot.
Yeah. I mean, I've been here 13 years, so.
Wow. That's cool.
Yeah.
Yeah, what we do, well, I'm in the United States, so we only work in the United States. And we raise capital for the syndicators across the United States in all different classes of real estate. So it could be multifamily or industrial, manufacturing, retail, office, self-storage, ground up construction, both in hotels and apartments.
Okay. So you have to have like a series license for that, right? Or
Well, we use our California broker's license.
okay.
Not everything's a 506. So if somebody actually wants to put together a real syndication, then you're just partnering with people. But the way these syndicators do it, yeah, you got to have a 506 B or C or D. And our California license, broker's license, so it's a real estate broker's license, allows us to raise money only for real estate.
Oh, okay.
Which is fine. That's all I care about. That's all we invest in is real estate. We're 100% real estate. We like an asset we can touch. We like an asset that we know is going to give a regular cash flow and probably will go up in value, maybe just a little at a time.
Mm-hmm.
Like that.
So with your personal portfolio, which sort of areas are you targeting?
The U.S.
Like states or anything?
So we're in Massachusetts, Vegas, California, Utah, Texas, trying to get everything I'm invested in because I do different classes. So I'm in like an apartment complex. I'm in a couple of, I love industrial. So that's where I'm really looking. I'm also in something in Nassau, which is a long-term lease. They're going to build their island's already there, but they're going to create the island as they're calling it Treasure Island. They've got a pirate ship and you'll go over for the day. The cruise ship will come in and you'll go over for the day and then you get to eat and sit out in the sun and hike 93 acres. And so they're getting that started. Yeah, so I love that deal. That's a fantastic deal. If you want to have a private conversation with me, I'll tell you more about it.
Yeah, definitely. That's what I'm trying to do is to diversify into some other asset classes because right now I'm 100% in residential. So, everything from my personal portfolio and then partnerships I have on multifamily, and then I have private placements as a passive investor in several multifamilies, but I don't have anything else in terms of like self-storage or industrial, and that's definitely something I'm looking to do as I move forward. So
yeah, well, it's all passive. We only do passive.
Yeah.
I wanted to find a place to put my money. I put a syndication together with three other guys, and we got it like 90% up to where it needed to be. And then we had about probably a 30% increase we could have made. And the guys decided, because they couldn't refi and get their money back, they wanted to sell it. Yeah. So I was the only one that said, no, don't sell. So I ended up making money, mind you, but I was looking at that as retirement. So then I had all this money and I needed to find new places. So that's actually how I got in the business again. Oh. So yeah, if you put your information in the chat, I'll contact you, and I'll also put the file in so you could download it and look at it.
Okay, great.
Hi everybody. I didn't mean to
No, that's okay. I love the networking part. Hey Daniel, nice to see you.
Hey, how you doing?
Good. I know Yan. Peggy, where are you from?
I'm in California. I'm in a small town right next to Pasadena, California, if you know California at all.
Yeah, close to LA, right?
Yep, we're in LA County.
LA County, right. Yeah, I know Jan's from New York and Daniel's from Japan now?
Yeah.
The farthest attendee for the meetup. That's awesome. I see Patty, Roger and Steven, where are you guys from? Maybe you can put it in the chat if you don't want to enable your video. And we're just about, there were some technical issues, so I'm just letting Badri join the meetup. Hey, Roger. I guess you're on mute. Maybe you want to unmute yourself. There you
How's
go.
this? That better?
Much better.
Oh, okay. Yeah, I'm also in the Los Angeles area,
Very nice.
and background is corporate world, retired, and moved into working with my wife on a design build business, residential construction. I have a real estate broker's license, and I've been working on passive income investing for the last several years. So essentially, all I do is it revolves around real estate.
Beautiful. You
Good
invest. There you go, Peggy. Stephen, maybe you want to put in the chat where you're from, but nice to have you here, Roger.
Thank you.
Hey guys, how's it going? I'm
Hey.
actually trying to get dinners ready for my boys.
Oh, that's
Henry
okay.
is actually right next to you. I'm actually in Merce Island, so it's not far from you.
Oh, nice.
Yeah.
Cool.
No, I was actually in New York. I grew up in Queens actually when I first moved here from Asia. So yeah, definitely miss Asia. I watched your podcast a couple weeks back on multifamily unit. Got really interested. So I'm a novice. I'm a rookie when it comes to real estate investment. I do have 2 rentals right now. I run a small consulting firm, and we're looking to further invest in our retirement planning, my wife and I. So yeah,
Beautiful.
love the show so far. So nice to meet everybody all. I'm going to try to get my dinners ready for the kids, but
Absolutely.
I'm
Go
going
do
to
your thing.
actually pay attention in a couple minutes, okay?
Nice to have you here,
Thank you.
Stephen. Hey, Badri. Apologize for the slight, the Zoom link that was missing, but
No worries.
finally you're here.
Yeah, I'm here.
How's everything going on your side, Badri?
Good. Looking
Yeah,
forward
there's
to the meeting.
definitely looking forward to your presentation today. Henry and maybe Yan, you want to get started with Coast to Coast, and I can give a quick intro to
Yeah.
Badri, and we can
Yeah,
get
sorry
started.
for technical difficulties, but now that we got everybody here, let's get
It's all
going.
good. Yeah.
Yeah. So I think this is our 15th Coast to Coast meetup. We are basically a member created by the members for the members here to share and learn about real estate. The meetup started with just friends and people we met at a boot camp, learning about real estate, multifamily investing, and we want to continue from there and keep learning. And so that we started this group. So there's only one expert, and everyone kind of knows a lot, and we can all share and learn together. So that's kind of great for that perspective. And we're here to learn from you. So other huge contributor to the group is here's Vivek, and he's in San Jose. And I'll let you introduce yourself a bit as well. And he also kind of developed his own multifamily analyzer, has lots of very technical, and also is a great guy to hang out with. He's in San Jose, and then also Yan is here as well, and she writes. She's background is in Wall Street. I'll let her introduce herself as well, as a risk manager, and she writes a blog called Invest with Confidence. So I guess you talk to her and get on her mailing list. And with that, why don't we turn it over to Vivek, and maybe you can help introduce our guest speaker today. Oh, I think you're on mute, Vivek.
Rookie mistake, huh? But yeah, thanks everyone for joining us this Thursday evening. Yeah, we've been trying to put up these meetups so that we can all learn together. Education is always something that I believe in, and there's never a point where you can stop learning. And this forum is where we learn new stuff. And talking about new stuff, I think Badri, our guest today, has something very innovative. I think when all of us think about real estate investing and syndications, we think about writing big checks and investing in one deal. His company, Avestor, has a very unique solution. I got to meet Badri on another meetup. I think it was a couple of months back, Badri.
Yeah, that's right.
Correct. So I met him on a meetup, and I really like the idea of diversifying, creating a portfolio in real estate. And I'll let Badri add any more introduction and maybe get started with the presentation.
Okay, thank you. I'll just provide my contact information. Everybody seems to be doing that. So let me just do that in the chat window. And then if anybody wants to just look at the website or whatever while I'm talking. So I actually invest in a wide range of instruments: commodities, options, hedge funds, venture capital, angel funds. But today, I'm happy to compare this with anything you want. But today, I'm here to talk about real estate. And the funny thing about this let me share my screen here. The funny thing about this presentation is it's a very high-level presentation. And I think a lot of this, some of this everyone will know, but I'm hoping that some of it you won't. And then if you want to talk about any one particular, please talk to me offline, and we can certainly go into a lot more detail. I would like the presentation to be fairly interactive. I would say if you have any questions, just interrupt me right in the flow. And if it's taking too long, we can take it toward the end. But right now, I would say just interrupt me at the end, right in the beginning. Yeah. So when you think about real estate, as Vivek said, you always think of, okay, what's the next deal you're going to buy? You don't think of it in terms of portfolio management. So when you think of portfolio management, it's fairly easy to build a stock portfolio, a little harder to build a bond portfolio. I mean, from individual bonds, I don't mean bond ETFs, and but much harder to build a real estate portfolio. And that's kind of what I'm here to talk about, So I want to talk about what are the main factors to consider, what are some different sources. Syndication deals are obviously one of them, but they're not the only one. There are plenty of other choices, yeah? So we are trying to help investors move from the left to the right. And I'm not going to spend a lot of time here talking about why real estate is good. I mean, I'm already in a group for real estate, so presumably there is some value to the fact that it's good to diversify with real estate. I'm not going to spend too much time. But when you build a real estate portfolio, you have significant capital requirements. You have to find the opportunities. You have to evaluate complex deal structures. You have to manage the risk. And you really haven't made any money until you have made some money, right? So until you exit and you actually sell a property or something, you haven't actually made any money. So timing of exit is always a little challenging, yeah? So what I would like to talk about is the different types of real estate deals. What are the main portfolio considerations you should be looking at when you build a real estate portfolio? And briefly, we'll talk about crowdfunding, how to accelerate crowdfunding to accelerate your portfolio building. And then just a quick 5-minute talk about Avestor and what we do and how we help you build custom real estate portfolios, yeah? So like I said, some of this is obvious. We'll start at 20,000 feet and start coming down. What are the different ways you can invest in real estate? I mean, you obviously can purchase individual properties. You can invest in equity deals, which are the syndication deals or the crowdfunding deals. You can buy shares in private REITs or private funds, or you can invest in debt deals, which is hard money loans, yeah? So just just to get some interactive conversation going, why don't you all type in as to which of these deals you have done? I mean, if you could just say, hey, done private REITs, private funds, debt deals, equity deals. If you could just type in the chat window, that'll be great. It'll give me a sense for what everybody has done before. So the direct property purchase is the most common thing. I'm not going to spend too much time on it. Everybody knows how that works, right? You buy a second home, put 25% cash, maybe it's a small multifamily, you get passive income and appreciation, you exit at your own timing. The main advantage is the renter is paying off your mortgage, so to speak, and you get all the tax benefits of depreciation. And the main disadvantage, of course, is you're managing the property, or you have to hire a property manager, and you have the single market risk. I mean, unless you have millions of dollars to invest where you buy a house in every single state, you are exposed to 1 or 2 states, and you're exposed to the economy of that state, yeah? And there is no easy liquidity on the invested capital. All pretty straightforward stuff, yeah? So then there are private real estate investment trusts, and it looks like some of you have done these deals. There are private REITs and public REITs. Public REITs are things which trade like the stock market. There are a publicly traded stock which invests in real estate. You can pick a particular sector. For example, I'm not recommending any specific thing. I'm just giving examples. Simon Property Group, for example, invests in malls. Public Storage invests in storage. The main advantages are they're very highly liquid, easy to research, and very low capital requirements. The disadvantage is very little transparency on the actual investments. They're tied to the stock market. See, that's the main disadvantage for me. The whole point of going into real estate is to diversify away from the stock market. But then if your portfolio goes up and down, real estate portfolio also goes up and down with the stock market, then one of the main objectives is not accomplished, at least from my perspective. I have invested in REITs, not that I haven't.
No, I agree with you, Badri. I mean, when it's too easy to get in and get out, the volatility kind of increases, right? I mean, from a portfolio theory.
Exactly. And you also don't get many of the tax benefits, exactly, Vivek, because you don't get the depreciation benefits for real estate. With private REITs, you may get some depreciation benefits. They're available through brokers or private funds. They're generally exempt from SEC registration. One of the main advantages is independent of the stock market, a little more transparency, but sometimes they can be complex, requires a fair amount of investor research, right? I mean, so again, I'm just kind of giving you a broad overview and then we'll dive into it a little more. Okay, this one, I think all of you are probably familiar with this, right? I mean, being in Vivek's group, if you come here, you must have heard a bunch of syndicators. The basic idea here is syndication deals very quickly. It allows you to get into large commercial deals, apartments, hotels, etc. And the investors are passive. There is a GP and the LP. The LP investors are passive. They get an equity stake. Sponsors and investors share in income ratios. You really have to be careful about the hurdle rates, and you have to be very careful about reading the agreements. You get different IRRs, about 13 to 27%. You get the tax benefits of owning the real estate directly. The main con is the minimum capital is $25, $50, $100,000 per deal, which is not too bad compared to investing in the property itself. But again, it's hard to build a diversified portfolio, which is what we are all about. And there is no liquidity, 3 to 7 years investment. You don't really have much control. GP has full decision authority. And if you look at the stack, the lien, the person who's given the loan, the lien is always with the person who's given the loan. So there is a chance you can lose 100% of your money. I mean, if you do your diligence, you won't, but there is a chance that you can lose 100% of your money. Yeah. So, and then debt deals. So how many of you have done debt deals? Has anyone done any hard money lending? Okay, Vivek has, Daniel has. So the general idea here is you're lending money, not a 30-year mortgage. Banks are in that business. You don't want to be in that business. And, I mean, I don't know if you really want to give your money out for 30 years for 2.5%. If you do, please come talk to me. And,
well, at 10%, it's really attractive, right?
Yeah, exactly. So you lend money to people who are, it's shorter term, 2 to 24 months, typically 6 to 15 months. These are notes where you lend money to somebody, and there are various crowdfunding platforms where you can invest as little as $5 or even $10 in some platforms. I'll mention some of them later. The main advantage is, I mean, of course, you can have notes which does not have the second lien, which has only, which does not have the first lien but has second lien. I encourage you to stick to notes which has the first lien, so that if anything goes wrong, you can take possession of the property. And as long as you ensure that the borrower has put 15 to 20% down, this is a good way and a pretty attractive alternative to the absolutely ridiculously low interest rates. I don't know about you, but I mean, I need a magnifying glass to look at those rates now these days in the bank, you know. So the con is the borrower may have limited record, and foreclosure processes can tie up capital for a long time, some potentially. So my advice there is you should invest in states which do not have a judicial process for foreclosure. So where you can take possession of the property rapidly, yeah? And be aware that the interest is considered interest income, and there is no tax benefits here, yeah? So
Badri, I mean, I think you had the capital stack on the right. Can you explain as to if debt deals come first in the pecking order before the equity?
Absolutely. The debt deals always come first in the pecking order, and just like a bond and a stock, right? I mean, if you go into the public markets, corporate bonds come earlier in the pecking order before stock equity, right? Thank you. It's a good observation. Yeah. So.
I have a question here about this because a lot of syndications now have A and B shares where, say, the A shares are kind of debt, where you're getting a 10% preferred return, and then the B shares are the equity where you get less of a preferred return, but will share the upside. So do those A shares, for example, would that fall under a debt deal?
No, I did not bring that here because I didn't want to complicate the situation too much. Typically, we do not invest in A and B shares. These are proper debt. When I say debt here, good question, I do mean debt. I mean, these are not the A shares, the preferred deal kind of a thing, you know? So it's actual debt where you have complete lien against the property. Sometimes the A shares don't have the lien against the property. It just depends. You have to look at the structure of the deal, yeah? So we typically do not invest in A shares. I mean, there's nothing wrong with that. Just like I personally never invest in preferred shares in the public market also. If you want debt, I suggest you go to debt. If you want equity, I suggest you go to equity, trying to get this combination. Sometimes they say it's the best of both worlds, but it also can be the worst of both worlds. You know? So it depends on the, I'm not saying categorically never do it, but it depends on the specific deal. Yeah. So.
Okay.
And great, just to add to that question, Daniel, I mean, when you say a debt deal, it's sort of a guaranteed return. If you don't get that interest payment, you can legally foreclose because you have a note secured by that property.
Exactly.
But on a Class A share, which is preferred return, preferred doesn't mean guaranteed. And they can accrue you up to that level. And I mean, until then, they give you the first, spoils, and then the partners take over. But it's no way guaranteed, right?
That's generally true, Vivek, but there are some deals where they almost structure it like debt and they guarantee a certain portion of it. I mean, like I said, there are various complex structures.
Sure.
We generally stay away from that where they actually guarantee the deal.
Like a mezzanine debt, if you will?
Yeah, exactly. And or sometimes even in preferred also, they structure it where the terms of the agreement show that it's guaranteed. But not very common, but there are such deals, yeah.
Interesting. Go ahead, Badri.
Yeah.
Good question, Dan.
Excellent question, yeah. So here are the top portfolio considerations you should look at when you build a real estate portfolio, okay? Some of this is applicable to stock and bond portfolios too, right? But we'll discuss this in the context of real estate. You have to look at the overall portfolio structure. What are the components of the portfolio? I'll talk about each one of this in detail. Diversification, what are the types of properties? What states you're investing in? How do you go about selecting a deal? What type of cash flow does it provide? I mean, for some people, cash flow may not be important. For some others, cash flow may be all important, right? What type of liquidity do you get? Now, we all think we never need money, but you never know. It's better to structure portfolios where you have periodic liquidity, 2, 3, 4, 5 years, every couple of years, yeah? You never know when you need the money, right? Especially during these times. And then how do you maximize the tax benefits? These are all considerations you should look at. So let's start with the first one, portfolio structure. Let's say that, I don't know, I mean, your real estate investment is considered the alternative class, right? I mean, alternative class of investment. I don't know why they consider it alternative class of investment. I think it should be one of the main classes of investment, but that's neither here nor there. So let's say you want to target 10, 15, 20% of a portfolio of $100 million. So let's say it's 200K, just for round numbers. And then you could, I mean, again, this obvious stuff. You could buy 2 single-family houses, 100K cash plus debt. You could buy 4 private funds at 50K each, or you could buy 8 syndication deals at 25K each, or you could do 40 debt K, 5K each. So these are the kind of questions you should be asking, right? I mean, obviously you can do a combination of everything. So the main thing I want you to think about is, by all means, go invest in your first crowd syndication deal, but always think about what is the overall portfolio you want to build 6, 5, 10 years from now. So think of this like a jigsaw puzzle. I mean, when you do a puzzle, you don't say, yeah, let me throw a piece here. Oh, let me just take another piece there, right? You're always thinking of what the end game is, and think of how you can build a real estate portfolio that balances risk and returns, yeah? So, and diversification is key, obviously. I mean, even with limited amounts, there are ways you can diversify across multiple states. I'm not saying you have to be Bill Gates to diversify across multiple states, right? So you want to diversify in multiple markets. I mean, just an example, Durham, Portland, Boston, they're completely different. If you look at the price appreciation, they all had completely different price appreciation and structure, yeah? So And you want to put your eggs in multiple baskets, right? So, and then in terms of deal selection, you really have to look at a number of property factors, right? In a single property, obviously the specifics of the property, the location, crime rate, how good is it? What's the value of the property? All that stuff. The debt servicing risk. I mean, if you rent it out, are you able to service your debt? I mean, do you have positive cash flow? What's the risk of the renters? If you're dealing with lower level Class C properties during these times, it might be an issue. And then debt deals is a superset of this, right? The borrower risk, the foreclosure flexibility. I talked about that, right? You want to invest in states where they don't have a long judicial process. In equity deals, finally, we talked a little bit about that. You have to look at the capital stack, the structure of the deal. Is it investor friendly or sponsor friendly? And the track record of the sponsor, how many deals have they exited? How many years have they been in business? I'm not saying each of this is a showstopper. The way we do it in Avestor is we look at all of these and we have a mathematical model. We'll talk about that a little later. So, but all of these factors have to be considered, yeah? And research every deal to minimize risk. And it's all important that you read the legal documents. It might be boring bedtime reading, but it's extremely important. Sometimes there are little nuggets which can make a deal completely uninvestable, yeah? So then look at the overall portfolio cash flow. You know how it goes. Purchase a rental property, you put some principal in, take some loan. Hopefully your monthly income is greater than this green arrow is greater than the yellow thing. You continue, and one day you get your nest egg, you sell it, and you get the capital appreciation. That's how it works, right? In a debt deal, you can either get monthly interest, or sometimes a lot of the debt deals are structured where the interest is paid only at the end of the deal, yeah? And then in equity deals, in value add deals, there is limited distributions. And again, being in this group, you probably are very familiar with it. In new construction deals, there's probably no distributions in early years. The distributions come in later years. Most of the money comes in principal returns when the property is sold, yeah? So you really want to build your portfolio based on your cash flow requirements. I mean, you have to have a spreadsheet. I mean, there are different tools out there. Build it and make sure that you know what the overall, how all your pieces fit together, yeah? So. And then the liquidity, again, for a purchase, you purchase a rental property, you have, you don't get any liquidity until you return. But if you have a broad portfolio where you invest in a mixture of funds and debt and REITs and everything else, you can generate some monthly income, and you can also ensure that you have liquidity events at periodic intervals. You may want to invest in some things which are exit in 3 years, some things which exit in 5 years. It's all about classic diversification and portfolio building, just like you would do it in a stock market, right? So, and then finally, the tax implications. I mean, again, I think most of you may already be familiar with this. Debt instruments always pay 1099 interest. As I indicated, any income you get from debt is always taxed at regular income tax rates. Now, equity investments give a K1, and typically you get the depreciation benefits. So you pay long-term capital gains, and private REITs and funds may give you a K1, or they may give you a 1099 div, okay? And generally you can take all of this, give it to your accountant, be aware of whether any equity investments in other states may require a filing in that state. And but here is one key point. When you get multiple K1s for these equity crowd syndication deals, you cannot offset one passive loss from one deal against passive gains in another, because IRS treats each of these as a separate investment, okay? So the way we built Avestor, we structured all of this in a single LP, so that you can actually offset passive losses from one against another. But it's something you have to be aware of if you do crowdfunding on your own, yeah? So.
Again, just want to throw out a caveat that
Sure.
This is not tax advice.
It's not, yeah, thank you. Yes.
Go ahead.
Yeah, please consult your tax advisor if for specifics of your.
No, because tax situations can depend, solely on an individual's situation.
Exactly.
So just throwing that caveat out there.
I was going to do that at the end, but I'm glad you threw it right now. So yeah. So just some brief regulations. SEC considers any of these securities, and most syndicators use the Reg D exemption. And I'm not going to spend too much time. You probably know all about this. Many of the really good deals require accredited investors. Accreditation is you have to be either $200,000 of income for the last 2 years if you're single, or 300 if it's joint. or $1 million net worth, excluding your primary home, as far as assets. But here is the good news. The good news is SEC laws changed very recently. I don't know if some of you are aware of it. You can pass the Series 65 exam, and even if you don't qualify from an income or asset perspective, you can actually become an accredited investor. And there's no difference. Once you get to the accreditation letter, it doesn't matter if you qualify based on the exam or you qualify based on the income or assets. Yeah. So let's see how are we doing in time. I think we're okay. Crowdfunding, I think all of you are familiar with that. That's exactly what it means, crowd and funding. So syndication deals are some variation of crowdfunding deals, right? So you're getting money from multiple people to invest in a particular property. There are various online marketplaces. It allows you to participate in larger projects. So the main advantage is you're a passive investor. You leave the complex projects to experts. But be aware of some things. Crowdfunding platforms, you should think of them as a seller's agent in real estate. So they get paid for raising funds effectively and quickly for investors. And the investor interests are not necessarily in the top of their mind. I'm not saying they're charlatans or anything like that, but their interest is raising money for investors. It's up to you to do the due diligence as to which deal is good. Yeah. Definitely look at all the PPMs, the limited partnership agreements. They can vary significantly from deals. Don't think there's all boilerplate stuff. And don't go based on just advertised returns. The IRRs can be easily adjusted by just changing the economic vacancy factor and doing tweaks in there. So you have to really look at the deal, analyze the deal thoroughly. And you do have to look through the financial statements. It's very important. I realize that can be a lot of work and it can be boring, but absolutely critical. And be aware that some of these deals may take longer than anticipated. Yeah. So to exit, they say estimated exit date, and that's exactly what it is. It's an estimated exit date. Yeah. So here are some crowdfunding options. If you want to buy complete ready-made properties in other states, not everybody wants to fly to another state or another city and look at properties. You could. There is Home Union and Roofstock where they can manage the property for you. I'm not recommending these. These are just examples, just to be clear. Or if you want private REITs and funds, there is Fundrise and Realty Mogul. You may have heard of them. Fundrise particularly is an option for non-accredited investors. The disadvantage of that is it's one size fits all. You get a small slice of a big pie and you're not sure what all is in the pie, but it's a good way. You can invest as little as $1,000, $2,000, $3,000. Yeah. And then in equity deals, of course, you can go to CrowdStreet, Equity Multiple. These are the syndication deals. You can go buy directly from the syndicators, of course, but you can also go to these marketplaces where you can buy crowd syndication deals. And then in individual commercial deals, there is Fund That Flip and Patch of Land. And the other one I would add here is Ground Floor. They're growing pretty rapidly. And the advantage of Ground Floor is it's open to non-accredited investors, and you can invest as little as $10 per deal. I was just surprised how scalable and how micro-sliced they have built the platform. Yeah. So my main summary is, by all means, get into real estate. Real estate provides a good diversification mechanism. But when you approach real estate, don't approach it one deal at a time. Obviously, you have to start somewhere. You don't buy 10 deals to start with. But always buy the first deal thinking of what your second deal should look like or third deal should like. It may not work out, but at least have some goal and have a strategy in mind. Yeah. And structure your goals, outline your investment goals very clearly, and make sure that you structure it for your liquidity needs, your cash flow needs. Consider tax consequences. Again, consult your tax advisor. This is not a talk to give tax advice. Crowdfunding can really accelerate portfolio building, but be cautious because these are platforms which are meant to generate investment for investors, not necessarily screen them for your benefit. Yeah.
So it seems like crowdfunding is just a platform to, market these deals, for lack of a better word.
Yes, they do some level of due diligence in screening it, but it's really a marketplace. Most of them are marketplaces, and you have to do your own due diligence before investing. Correct.
Got it.
Yeah. Any other comments or questions?
One question.
Sure.
So let's say it's the same deal. If you get it through crowdfunding versus you get it directly from like a syndicator, let's just assume this is the case. Do they have the same tax implication?
Yes. Again, you should consult your tax advisor, standard disclaimer, but I would say in general, yes. And in general, most crowdfunding platforms as of today do not charge the investor anything. They charge the people who are raising the money. So there is no real disadvantage for you to go to a deal through a crowdfunding platform. And in fact, there may be an advantage because there may be a single place for you to track all your different investments. So.
Right, but like the depreciation benefit.
It's all the same. It's all
okay. Got it.
Yeah.
Okay, thank you.
Sure.
So net to the investor, it doesn't change, but it's just that maybe not all syndicators advertise it on a crowdfunding platform.
Right. You have to become a little bigger syndicator, for example, to invest in advertise in something like CrowdStreet, right? Because
makes sense.
The fee structures are pretty high and things like that. Yeah. So.
Got it.
So a brief introduction about Avestor. Avestor, I'm a co-founder of Avestor. It's an online platform where investors can build custom real estate portfolios. Now, we practice what we preach. We are all about building portfolios and not one deal at a time. I think that's very important for all classes of assets. I don't mean, hey, this is true only for real estate and Avestor is the only way of doing it. I'm not saying that at all. For any asset class, you really want to build a portfolio and you want to have a diversified set of things. And there are various mechanisms you can do, like I said, to build this portfolio. And we have a mathematical model. We evaluate a deal from over 40 different variables. And we have dealt with hundreds of deals and maybe approaching 1,000 soon. And we pre-invest in these deals. And then the investors can come along and customize the portfolio to align with their investment goals. Just like you go to an investment advisor and say, I'm pretty risk averse. I really want fixed income. So 70% stocks, 30% bonds. You know that you have heard that kind of spiel before, right? So we do a thorough analysis of the investor needs and then we customize it. You can diversify in different states, time horizons, and asset types. We invest in student housing, multifamily, retail, and a variety of things like that. And then we call ourselves the fidelity of real estate. So it's very transparent. I'll give you a 2-minute demo after this. And you can track the earnings and performance of each deal, just like you log into a stock account or something and see how each thing is done. And then we structure it to meet your liquidity needs. You can say, hey, I have a kid going to college. All of you look too young. You probably don't have kids going to college, but let's use that as a hypothetical example. And so I want some of my money back in 2 years and 25% I don't mind investing in the long term. So we structure it that way. And here is the biggest thing. All of this is packaged in a single LP structure. So even if you invest in 20 deals, we have spent hundreds of thousands of dollars in building the legal and technology platform where you get a single K1. And apart from the obvious advantages and reduction in complexity, you can offset passive losses from one against passive gains in another. So that's, to us, is a big advantage, yeah? So again, to recap, we research the deal, we pre-invest in the deal is cut into small slices of $500 to $2,500 or more. You come along, set your portfolio direction, these slices are matched, and we build a custom portfolio. You get a pro rata share of the earnings, and investors can either withdraw the money when deals exit, or you can reinvest, yeah? So let me give you a really quick demo. This is more of an educational talk, so I do want to keep it very short. And this is what it looks like when you log in. Again, this took multiple years, man years of effort to develop. Built highly scalable, built on the Azure platform. You see the account balance, the number of deals, the return on the deals which have exited. See, we offer both equity and debt. We talked about that, right? So these are all debt deals because equity deals take a little longer to exit. And the total earnings, the breakdown between commercial debt, residential debt, and equity. And then you have this little map honestly, it's like a little vanity map. You click on anything and you can kind of see more details on how your deals are distributed. These are deals you have invested, not the deals which we have. And this tells you the number of deals you have exited. And this is the liquidity graph. Tells you approximately how much money you're getting each year. Now, be aware, this is not like you'll get your money on June 20th, 2021, approximately. I mean, you'll get that money back approximately in that year. And then finally, we have this portfolio details. It's just like what I said. You log into a TD Ameritrade or a Fidelity. For example, this person has invested $1,000 in this debt deal. It's a Manhattan debt. Estimated exit is 2021, 9.5% return. And you can see he's made $100 so far and 10% total return so far. You generally get the idea. And for equity deals, we put $2,500 per deal. Yeah. We invest in student housing, apartment complexes, retail centers. For example, we also invest in self-storage. The idea is to get diversification across asset classes and states and timeframes. That's the basic idea. So would love to talk to you more about this. If you have any questions, if you are interested in this, please type in your contact information and I'm happy to reach out. I've also given my contact information. So that is the summary of the presentation, really. I mean, I'm happy to go back to the educational part, or if you're interested in seeing a little more about this platform, if you have any questions about Avestor, or you have any questions about building a diversified portfolio, I'm happy to talk. So
I have a question, if I could.
Sure.
How does Avestor deal with your existing deals? So if I already own, single family houses, multifamily houses, and then everything, does that get factored into the Avestor platform so we can see how those work with what I'm investing with you guys?
No, but when we talk to you, we ask you what you have and we try to give you complementary assets. Okay. Having said that, let me give a plug for one of our partners. There is, I don't know if you have heard of bettercapital.us. Okay.
No.
It's a Bay Area company. And so they are a startup too. We are partnering with them. What they are doing is something called the Mint for real estate. So it's a single platform where you can keep track of all your syndication deals, your single family assets, and it's free up to a certain number of, you can track up to 10 assets free or whatever. I'll let you go look at it.
Okay.
So, we are tightly integrating Avestor with that. So if you do invest in Avestor, the Avestor portfolio will be imported into bettercapital.us. Yeah.
Okay.
So, I don't know if I answered your question. Two parts. When we talk to you, we do check into your current real estate allocation so we can build a complementary portfolio. But we can't let you really import all that into Avestor platform, but to this other platform and you can track both. So.
Okay.
Thanks.
So I have a question. Does that
Sure.
mean that, so you said this are all like a pre-invested deals, right? So
right.
when we invested, does that mean that we actually replace your stake in that deal?
Okay. So the way it works is Avestor LLC is a GP in the deal. So let's say we do $100,000 chunk. For example, recently we invested in the Neil Bauer deal. I don't know if you know who Neil Bauer is, one of the syndicators.
Yeah.
And the deal sold out pretty fast. I'm not trying to sell any particular deal. So let's say we invest $100,000. We slice it into $2,500 chunks. The Avestor partners are also LP in the deal. So I have personally invested as an LP in every single deal in Avestor. And so as my other partner. So that slice is allocated to us and we get to keep it, right? As an LP, just as the same rights as your LP. But what GP slices get allocated away so that eventually it is allocated to the new investors. I don't know if I answered your question or you'd like me to clarify that more.
So we are, let's use this example. So Avestor investing in Neil Bauer's deal,
okay.
as a GP. And
right.
then the part that you dice is actually the GP part of it. So basically, it's a LP share of a GP
Correct.
side.
So we invest $100,000, and let me keep it in simple. We slice it into 40 $2,500 chunks. Some people invest only $2,500. I personally also invest in the deal as an LP. So that goes into my personal account, not the Avestor account, my personal account. I kind of practice what I preach. I have a personal account on Avestor. And then the GP's chunk eventually goes to zero because it gets all allocated to individual partners. Yeah. So
you're putting skin in the game by not just you're not just giving GP shares, but you're also putting your own money to back it up.
Exactly.
Got it. And Badri, can you speak a little bit about the liquidity that Avestor offers? Because if say you invest in a syndication and I get a slice of I get a 2,500 slice of an investment syndication. Do I have the obligation of keeping it for 5 years, or can I exit
right now
that?
You do. You do. But we are thinking of having a marketplace kind of a thing where you can resell it to other investors as they come in, maybe a few months from now. It's not guaranteed, but right now you should assume you do. The way liquidity works is we structure your portfolio so that you get different slices. There are some slices which may be debt, which can exit in 6 months or a year. Some slices in deals which go on for 3 years. Some slices which are deals which go on for 4 years. So we tell you, and like I tell you, it's an approximate thing. It's not a precise date. It's not like a CD. On June 28th, 2021, you'll get your money back. But for now, that $2,500 slice, you have to keep it until the deal exits.
Got it. So you kind of structure the portfolio, help us structure the portfolio where cash flow happens so that you get that liquidity. You spread the liquidity through a period of time. Got it.
Exactly. So it's not liquidity in the sense where you can resell it, but you may be able to do that in the future. We are not quite ready to do that right now. So.
Badri, can you comment on your due diligence process? Because in essence, what I'm hearing is that we're making investment decisions, and then these investments are on the platform,
right,
by which your LP investors can participate. And so the starting point is that Avestor must go through a due diligence process on who they select to invest with, that they're going to share with their investors.
Right. Sorry, who's speaking?
It's Roger.
Oh, Roger. Okay, sorry, I couldn't quite make out. Yeah, thanks. So let me just show you one quick slide. I highly encourage you to contact me offline because I don't know if everyone is interested. Like I said, we have a very strict due diligence process. We look at about 40 to 50 different variables. Things include like the location, how attractive the location is, the exit date, the target return. We have a social justice assessment too. I'm assuming you can still see my slide, right? I don't want to be talking to the air. And then we'll do a very extensive analysis of the capital stack. The other partner is a VP at Intel. He's done extensive financial analysis, and we have built multiple models. And we look at the preferred equity, the sponsor equity, if there is any mezzanine debt. Then we look at the different hurdle rates. Is it investor friendly? We have what we call the prototypical model, and we compare it with the model. Remember, we have data on hundreds of deals. And then we look at the debt servicing risk, the net operating income, track record of the sponsor, how many years they've been in business, assets under management. If it's retail, single renter dependency, are they essential or non-essential businesses, large customers. And for foreclosures, we have a point system for different states. We like to invest in states. Sorry, this is not for equity, this is for debt. Where we look at states where the judicial process is, there's no, you don't have to go to the court.
Alert from calendar. Go to webinar, find JV partners and raise capital.
What's that? I heard something. Oh, okay. Somebody is not muted. Okay.
I guess there's a surprise visitor, but go ahead.
Okay. All right. Beyond this, I would encourage you to talk to me offline because we do a pretty extensive analysis, and that's part of our, in fact, eventually, maybe a year from now, we may expose this data to investors. So just like you guys know Zillow, right? The Z estimate. So we may create a Avestor estimate or a estimate. Okay, I have to come up with some fancy marketing name for a syndication deal, you come in and you type in all your information. There's a calculator and which tells you our opinion. Standard legal disclaimer explain, please don't depend on us. I mean, do your own due diligence, etc., etc., etc. But we'll give you our opinion. Not right now. That's maybe down the road, because we have, the data is very valuable. I mean, in fact, we are talking to some people who want access to the data. We are talking to a bunch of Wall Street guys who want to use this platform to build a customizable real estate investment trust. And they also want access to all the data we have on the deals. Okay, long-winded answer to your question. Hopefully I answered your question, Roger.
Yes, thank you. I'll email you separately. Thank
Okay,
you.
sounds good. Thank you. Other questions?
Any more questions for Badri at this point?
Yeah, I have a couple more quick questions for this.
Yeah, go for it. We still have time, I think.
Okay, so first of all, do you need to be accredited for?
Yes, I'm sorry. I should have mentioned that. We might start a public fund down the road, but right now the deals we are investing in are accredited deals. We can't be a middleman where we take an accredited deal and give it to non-accredited investors. That's a quick way of going to jail. So for now, it is open to only accredited investors, but we may create a public fund where the fund itself is accredited. So but right now the answer is yes.
Okay.
And the last thing I wanted to mention is the way we make money. Our thing is completely aligned with the investors. I didn't mention that, so just so that you're aware. We do not take any of the fees. We don't charge performance fees. Every penny which you get from the deal goes to you in a pro rata fashion, of course. You're not going to get everything for $100,000 if you invest $2,500. Now that would be a good deal. We charge 1% for portfolios above 100,000 and 1.25% for portfolios below 100,000. But for that, you get the single K1, you get the screening, and you get this, all the other benefits of the platform. So 1.25 for above 100, I mean, the other way around, 1.25 for below 100 and 1 for above 100.
Okay. That was my second question. And my third question was, is there a minimum investment amount?
Yeah. So the minimum investment is just because there is a certain overhead. I mean, we'll slice the deal into $10 chunks, but we really don't want the investor coming in and putting $10. I mean, it's a quick way of getting out of business, right? So we talked about the different minimums, but right now we are keeping it relatively low, maybe not too low, to $25,000. But for $25,000, you're investing in at least 15 to 20 investments. Maybe 5 or 6 debt investments and 10 equity. Sorry, the other way around. 10 debt investments and 4 or 5 equity investments. Yeah. Okay. So, but our typical portfolio, typical account size is $50,000 to $100,000, because most people who have joined the platform, 85% of them have put additional money. They just like it. So.
And last question, can you rebalance the portfolio? Like, for example, if I've already signed, okay. Like if I'm keep investing on my own and then I need to rebalance to do it.
Rebalance for new deals, for new money you put in. You can't sell an equity deal right now. We talked about that, right? For new money, you can put in, hey, I already have a lot of exposure to, you can even come and tell us, hey, I'm in California. I don't know where you are, but let's say you're in California. I don't really want any exposure to California. I want, and you can say, hey, I like student housing. Let me do some student housing or self-storage. Or you can say, recently I started buying new construction deals. I want more value add. So it's all about a custom portfolio for your needs. It's not about what we want or what we can sell you. Unlike a crowdfunding platform, we are not trying to get money for investors. We are trying to build a long-term diversified portfolio. So.
I have 3 questions.
Okay.
The first one is that, let's say I invested in one of the like your syndication deal, right? So, so let's say this is a value add deal, right? So definitely the time that when I enter the deal is different, then the return profile will look different, right? So before stabilized versus stabilized versus close to sell, right? So then if like different investors, they enter into the deal at different time, do they get the same return? That's the first question.
Can I answer that before you move on to the second one?
Yeah, please.
Thank you so much for asking that question. That's one of the fantastic features of Avestor, and we have spent lots of money in building a complex system where we take into account, and that's why the REITs want to use this as a platform. We take into account the time value of money. So, for example, if an investor comes 6 months later, you look at the total money which you get from the exit, and you automatically calculate all that. So you take the preferred return. I mean, it's a little complex to get into. You take the total money which you get in the depreciation, and then you prorate it. So as a GP, for example, maybe we invested in the deal for 6 months. We want our money too. I mean, we don't want to just tie up our money for 6 months for not getting anything. So that's why this is a very attractive platform for a syndicator, because then you can raise money on a continuous basis. But that's beyond the scope of this conversation. So we will, I mean, it's a little complex to explain right now, but you absolutely will take into account the fact that you came in at a later stage. And then we look at the overall calculation, and we calculate it and ensure your money is equitably distributed. And we are happy to share with you all the formula calculation.
That would be perfect. So the second question is that I'm still trying to understand this new concept, because literally just 30 minutes before this webinar, I listened to Hunter Thompson. He talked about like LP invested in this GP share. So I'm still trying to understand this one, because GP, we all know that they make money towards the end of the deal, right? So if I invested as an LP of the GP share, does it also mean that basically I only get compensated towards the end?
Okay, so let me answer that question before you move on to the next question. I'm getting old, I might forget the question. No, I'm just kidding. So basically, I don't want you to think of this as a GP. I mean, that might be confusing. Mm-hmm. We are all LPs. Avestor, when they invest, also is an LP. We are not a GP in the deal. The syndicator who is building the deal is the GP. We are a GP of the fund, that's all. We are not the GP of the deal. So we are all LPs. Okay. So whatever we get is what you get. I mean, we are all LPs. We don't do any of our deals. We are not syndicators. We don't intend to become syndicators. We don't plan to be GPs of any deals. We evaluate. So if once we become GPs, then our bias is there, right? How can I honestly tell you that I'm evaluating my own deal the same way I'm evaluating another deal? Oh, yeah. But this deal is extra special because we are doing it, right? So
yeah, that makes sense.
We are all LPs. Think of it that way. I use the word GP as a GP of the fund, but Avestor is also an LP. So
that makes perfect sense. Yeah. Okay. Last question is that let's say I want to do my own due diligence per each deal that I want to invest it in.
Yeah, absolutely.
Do I see all those? I don't want to see your analysis right now. It's not available. I understand that. But do I see everything like the PPM or whatever?
Absolutely. You can get access to all the information. Mm-hmm. Right now, it is a manual email right now, but within a few weeks, we are right in the middle of developing it, where when you log into the platform, you have all access to every document we have. We'll have a huge document database. Right now, we'll give that to you manually access, to be honest, but within a few weeks, that'll be available on the platform itself.
Got it. That will be the same exact information if I invested directly.
Exactly. For example, you will have access to all of that. And not only that, we'll give you our analysis too. We'll tell you, hey, why we are investing in this deal, what our point score. I'm not going to share the proprietary formula and all the details of that. That's our value add. But we'll give you the summary of the points, and we'll give you a high-level overview as to why we invested in that deal.
Got it. Okay. Thank you very much.
Sure.
Great questions, everyone.
Yeah, excellent questions. So.
Okay, so it is approaching 6 o'clock. I think this is going to be the breakout session. So what I'm going to do is first going to set up this breakout room, but I also want you guys to take a minute to answer this poll. So it's kind of fun. I call it, let's take a temperature, kind of see where you guys think about the current market, where you're looking to invest or already investing. So go ahead, fill the poll while I try to set up the breakout room.
Hey, Henry, can I mention just one thing? I think people already do. If you want to save your chat window, please do so. My contact information is there if you would like to. And you also get the names of everything else. So if you go to the chat window, you can kind of see on the right side, there's a way to save the chat window. Your people probably already know that. I thought I would just mention it. Yeah. So.
Yeah. Good point.
Thanks for mentioning that, Badri. I mean, I can send all the information through the recording as well, so that way everyone's going to get that.
Okay.